Welcome back, guys. Thank you so much for clicking on today's video. Today we're doing an introduction to options. Before I start the video, guys, please make sure to leave a like on the video below. Subscribe to the channel for more awesome content. Join the family, guys. Let's go on our investing journey together. So, a lot of people when they start their investing journey, right, they start trading stocks at first and, they buy and sell at a higher, lower price. And then as your trading journey actually begins to progress, they start hearing the word options. And so, to start the video off, I'm actually going to answer what options are, but basically what an option is, it's a contract that offers the buyer the opportunity to buy or sell a contract for an underlying asset. In short terms, right, you're basically buying contracts of an actual stock itself. So if we go to the trade button, we're going to be using the S&P 500 as an overall example, just because it's the world's most traded ETF and it's very easy to use as an example. So if you have your options enabled in your Robinhood app, when you click trade, you should see a trade options button right there. If you do not see this button, it is just because you don't have your options actually enabled, which you can do in your settings. It takes 5 minutes and it's completely free, so try it out. So when you click trade options, you're going to see dates at the top. What are these dates? So these dates are actually expirations for your contract, right? So if I click on September 21st and I want to buy the 336 call, it just means that my contract is going to expire on this specific date. So we're going to get into that a little bit later, but first, there's two types of options you can buy, guys. All right, so there's calls and there's puts. So what's a call and what's a put? So when you buy a call, you are very bullish about a stock. You think that the stock is going to be going in the upward direction. With the put, if you're buying puts, you have a bearish opinion about a stock. You think a stock is going to go down. You can make money doing both. You just have to call it right. So looking at the overall prices, you see a 338 call. And if you switch over, you see 338 put. So what these are called strike prices, right? So when you're playing options, you can see a whole list of prices that range a huge variety, right? So these overall strike prices are basically what you think the stock is going to go to. So for example, looking at the 337 call, if I buy this call, I think that the SPY is going to go up to 337. If I go to the put and I buy the 336 put, I think SPY is going to go below 336. Overall, the strike prices are super important of when you're playing options, and here's why. You don't want to buy an option that's super out of reach. So anything below the stock price on the call section here, so the 336, the 335, and the 334, those contracts are in the money, right? So the S&P 500 has already passed those prices. Anything above that current share price is called out of the money. Me personally, just my personal recommendation, not financial advice, I always play contracts that are in the money. Just easier way to make money. When you're playing puts, it's actually the opposite. So when you're looking at it overall, you guys have to make sure when you're playing options that you're super careful of when you're playing options. You don't want to buy, for example, a 344 call on SPY by September 21st. It's very risky, and the chances of SPY hitting that in one day is very unlikely. It's a very easy way to lose money, right? So I always tell people, if you have a very bullish sentiment about SPY can rally a couple of dollars, so buy the 338 call, for example. You have a better chance of making money. But you guys see prices listed on the side, and a lot of people, you see $2.03 for the 336 call, $1.61 for the 337 call, and $1.26 for the 338 call. We're going to use the 337 call as an example. So you guys see $1.61. So what does that mean? Does that mean the overall contract for S&P 500 is $1.61? No. So when you're playing options, guys, you're buying the right to own 100 shares of the stock at a specific price. So doing simple math, if you have the right to own 100 shares, you're going to times the contract share price by $100. So this contract is $1.61, but you have to times it by 100 because if you see here at the top, it says contracts times 100 shares. Now, you're not actually buying 100 shares of S&P 500. You're buying the right to buy 100 shares of the S&P 500 at this current price. So if you buy this and the stock rallies to 338, you're probably going to make some money. Super important to know that everything is always going to be times 100. And if we switch over to the put section, guys, it's the exact same thing, right? If we put one on this exact SPY contract, it's $3.49 times 100, making it $349. All right. So, and then looking at the top here, you have different expiration dates. You can buy calls or puts for September 23rd, September 25th, and these can range all the way to 2022 actually. So when I'm playing options specifically, I don't play options all the time, but when I do play options, I always recommend playing options that are super far out, and here's why. The reason I like playing options that have farther expiration dates is because theta doesn't eat away at your gains. What is theta? Theta is something that eats away at the cost of your contract the closer your contract gets to expiration. So what does that mean in English? So we're going to click on the contract here, and we're going to click on this. If you guys see at the bottom, you see something called theta, right? It's minus 0.2617. Times that by 100, that means I've lost $26 off this contract just due to theta. So theta eats away at the price of your contract the closer your contract gets to expiration. So if you have the September 21st contract, theta is going to eat away at a lot of your gains, right? So that's why I always like to play options that are super far out, because theta does not eat away at your gains as quickly. And you'll notice this a lot when you're playing options and you buy weekly options that expire in the week. You notice that the closer it gets to the expiration of the contract, theta really starts to eat away at the price of your contract. This is why I personally recommend always playing contracts that are super far out. Now, looking at the bottom here, we have a bid and the ask. So, what does this mean? The bid is what people are offering you for your contract. So, for this specific contract, people are bidding me or asking for $1.59, while the people who hold the contract are asking for $163. This is actually really cool, because here when it says mark, it shows 161. It gives you the average. Now, the cool thing about the S&P 500, and something I personally like about the S&P 500 when I'm playing options, is you guys notice that the bid and the ask are super close together. That's a good thing. In some cases, especially when it comes to like Chipotle, Tesla, and all these other types of option contracts, the bid and the ask are not always close together, and that makes the stock super unappetizing. Because, for example, let's say you called it right? You bought a call on Domino's Pizza for $500, but the bid is $200. That person's not going to ask for $500. He wants $200 for your contract. Therefore, you're going to have to sell your contract for a lot lower, and you're going to lose out on a lot of money. This is why I always personally play options that are super close in the bid and the ask price. That's just my personal preference. You guys don't have to do what I personally do, but that's just kind of the way I like to do it personally. Also, too, guys, see, if we go to the September 28th, I'm going to use a theta example really quickly. If we go to September 28th and we click on the 336 call, right, looking at the bottom, theta is only 18 cents here instead of the 27. And it does make a difference, because not only does theta eat away less, but you have more time for SPY to actually go in your direction. You actually have more time in the option to go in the direction itself. And the biggest thing on why people actually like to play options is because you know your risk, right? So let's use the 337 call as an example. We're going to play one contract of SPY for tomorrow. Let's say I wanted to buy this. I think SPY is going up. The cool thing is I know what my max loss is going to be. The cool thing about options is if SPY continues to rally forever, you can make an infinite amount of money, which is super cool, and that's why people like playing options. But if, let's say, SPY decided to go to zero today, even though SPY is $336, I'm only going to lose $161 because that's all you invested. There's a huge risk adversity here, and that's why people like to play options. When you're playing options, you know what you can lose. And that's what makes options super appetizing. And a lot of people like to buy options in bulk, although I don't recommend this. But you can also play options for earnings, which a lot of people like to do. Let's say sometimes you call an earnings right, and the options are probably going to be worth a lot the next day and stuff like that. That's why people love to play options. Options are a great way to actually learn, and it's a very cool strategy. And the cool thing is about options, there's so many options you can do, guys. You can sell naked calls, you can sell debit spreads, you can sell credit spreads, you can do so many things with options, and it's a whole new world of trading. And it really does overall actually open your eyes to the trading world in itself, and you guys can see the actual potential to make a lot of money off options. But please be aware, guys, options are very risky, and you have to know this before playing options. For example, we're going to scroll up here. I know that the 348 call for SPY that expires the 21st of September, it's only $7, right? So why not buy 100 of them? It's the same cost of buying 5 $338 calls. The thing is, the 348 call doesn't really have a chance of making money, so you don't want to do stuff like that, guys. You want to buy options that are super close to the share price in itself. It's the best way to make money, and it's the best way to not lose a lot of your portfolio. Something else I also want to advise with you guys, do not YOLO all your money into one play. That's the quickest way to lose your portfolio. This is not Wall Street bets. If you want to be a good trader, you got to trade strategically, and I know a lot of people who make a lot of money off options. Overall, I always recommend when you're playing options to buy out super far dates so theta doesn't eat away at your gains, guys. Remember, theta is something that eats away at the price of your contract. You don't want that. You don't want theta to eat at the price of your contract, right? And then also, something I recommend is buying contracts, whether it be puts or calls, of contracts that are already in the money. For example, for puts, the 337 call or the 337 put, 338 put is probably something I would buy. I would buy this 337 put. It's already in the money. Now remember, when you're playing puts, it's actually the reverse. So the 337 and the 338 are already in the money. Anything below the share price for puts is in the money, and it's the opposite for calls. But I always recommend people to play, when you're playing options, buy something close to the share price. Don't buy something that's $20, $30 out, because the chances of you making money on it are going to be very, very low. And the last thing I want to go over when it comes to playing options is something we call implied volatility. What is implied volatility? So implied volatility, if a company has a huge announcement or very good earnings, you'll notice the price of your contract fluctuate a lot. On a normal day, you don't see this, but let's say SPY tomorrow, we had very good stuff like that. We had unemployment was going down. SPY goes to 345. It goes up $9. This contract here is probably going to be worth probably about $1,500 off a $200 play, but that's not always the case, right? Implied volatility can also make the price of your contract go down. So let's say you're playing earnings, right? You buy a $336 call for SPY, and they missed their earnings and they did not do very well in their earnings at all. Let's say the next day you come to sell it. Although SPY may have tanked only $3, nobody wants to buy your contract. Therefore, your SPY contract will probably be worth $50, and you lost basically all the money invested in that contract. So implied volatility plays a role when there's usually huge news around a stock, and that's when people usually like to play options. So last thing I want to recommend, guys, kind of the takeaway of this video is avoid the same mistakes I did when I was playing options. 1, never buy options that are super, super far out of the money. So if I'm playing calls, don't buy the 345 call if the chances of it happening are very, very slim. Same with puts. Don't buy the 326 put just because it's very, very cheap, right? So avoid playing options that are super, super far out of the money because the chances of you making money on them are very slim to none. The second takeaway is don't YOLO all your money into one play. If you have $5,000 to invest, don't go buy 20 contracts of S&P 500 and expect to win because that's a quick way to lose money. And number 3, guys, always have fun with it and make sure you guys do your research before you actually play options. Options are super risky and you can make a lot of money playing options, but you can also lose a lot of money. So it's super important to remember to always know what actually makes options go up and down. Remember, guys, at the end of the day, you're essentially just placing a bet on whether you think a stock is going to go up or down. Remember from the beginning of the video, a call means you think a stock is going to go up, while a put means you think a stock is going to go down. Overall, despite whether you call it right or not, you guys have to be careful because sometimes implied volatility and theta can eat away at the price of your contract. Options do take practice, and I do recommend practicing with like kind of a cheaper play so that way you guys can actually get the hang of it. But the S&P 500 is a good stock to trade on when you're first starting options because the bid and the ask price are super close together. Remember, guys, I don't recommend trading options where the bid and ask are not super close together. If I click on this 336 call one more time for an example, the bid is $2 and the ask is $205. That's super close together. But in other scenarios, the bid could be $1 and the ask could be $205. That's a $105 difference on the contract. So it makes it very difficult to actually sell the contract for the price that you want. But with that being said, guys, that's all I really have to say about the video. Hopefully you guys found the video informative and hopefully you guys liked the video. I really appreciate any feedback on my videos. Please don't forget to leave a like, guys. Subscribe to the channel for more awesome content. Thank you, guys. Have a good day.